We've got U.S. jobs numbers coming in stronger than expected. That has implications, of course, for interest rates and the bond market. Exactly what are those implications? Joining us now to discuss, Hafiz Noordin, VP and Director for Active Fixed Income Portfolio Management with TD Asset Management. Hafiz, great to have you back on the program.
It's great to be back.
Job numbers were a little bit delayed. We got them, and they were stronger than we expected. We are seeing market reaction. Walk us through what we got.
Yeah, I mean, if you were worried at all about the labor market cracking in the U.S., and there was a bit of fear of that building over the last couple of weeks, we had weak job opening data. Today definitely, dismissed some of those fears. You had 130,000 jobs created in the U.S. in January. That was double the economist consensus forecast of 65,000. And what really was encouraging out of that was that the private to public mix was very strong as well. Private jobs were actually up 170,000, and there was a detraction in public and government jobs. So generally, a healthy economy in the U.S., you see, the private sector leading job gains, and so we did see that. And then along with that, unemployment rate went from 4.4 to 4.3%, and wage growth was steady. So the average hourly earnings data that comes with this was steady at around 3.7% year over year. So all in all, pretty good, and I think shows that there has been some communication from the Trump administration. They were even yesterday signaling that let's not be too worried if it's a weak data print. But really, we know that we're not expecting 200,000 jobs per month anymore because immigration is not as high in the U.S. anymore. We've perhaps even seen that outward migration. The idea was that maybe just below 100,000 per month is a more steady state area. This is still well above that. So all in all, the U.S. is continuing to chug along just fine.
So what does the Fed do with numbers like this? Of course, then people take a look at this and try to guess, will the Fed cut, the next meeting, the meeting after that, now the meeting after that? The market expectations seem to be shifting.
Yeah, it's been hovering around this idea of 2 cuts this year. This hasn't changed that materially, but it is calling to question the timing of that first cut. And so we know that Kevin Warsh is coming in as the new chair. The idea was that his first meeting, which would be in June, was when he would start with a cut right out of the gate. And that was fully priced in before the sprint. Now with this strong jobs data, that's about 70% priced in for June. But you still see that when you look at market pricing for the full year, by the end of December, still 2 cuts priced in for the Federal Reserve. So I think the idea is that this was, yes, a strong print. It's reduced the risk of more than 2 cuts for now, but it's the Federal Reserve's policy rate is still considered above neutral, even when we're seeing this kind of data.
Do these kind of numbers mean much for the broader bond market? I mean, it's perhaps changed expectations of when, but not how many for the Fed. What about the bond market?
Yeah, and so the U.S. 10-year is a good way to kind of think about that. And what we have basically seen over the last couple of months is that the U.S. 10-year has been kind of stuck in around 4.2%, plus or minus, maybe 10 basis points. Like it's been really in a small range. And that's because there's been kind of a mixed data on the labor market, on consumption, and again speaks to this sort of steady state, but not rapidly deteriorating economic condition for the U.S. So that's basically meant generally pretty stable bond yields in the U.S. And similarly in Canada. It did also, I think, on the currency side, put a bit of a, reduced some of the momentum we saw this year in a decline in the U.S. dollar. So we're seeing the U.S. dollar a little bit firmer today, but I wouldn't call it a big rebound. I wouldn't say there's a big shift in sentiment towards, materially higher U.S. bond yields or a materially higher U.S. dollar.
You were talking a moment ago about Kevin Warsh getting the nomination, of course, with the expectations of what it's going to mean for cuts. But more broadly speaking, the market's had, about 2 weeks now to sort of digest this information. Do they seem at peace with the idea that this will continue to be an independent Fed?
Yes, I think so. And I think what we saw out of the gate from the announcement was that there was definitely some, I'd call a positioning washout in the market of any types of trades that were really betting on a significant debasement in the U.S. dollar or, a materially easy monetary policy. It was sort of like, okay, let's take a step back here. Kevin Warsh is coming in as an experienced member past member of the Federal Reserve. And although to audition for that role, you would have had to be supportive of rate cuts to Donald Trump, at the end of the day, the data is going to guide the Fed. When we kind of saw all of that sort of shake out, at the end of the day, still back to this kind of 2 cuts. And I think what's going to be more important now that we know that the labor market's still kind of stable, the inflation data will, I think, be critical. We had CPI data this Friday.
What are we thinking about that?
Yeah, so the market's priced in about a 2.5% year-over-year rate. So it's still this kind of sticky inflation environment, 2 to 3%. But for the most part, that's kind of good enough. And I think for Kevin Warsh, probably will also say that that's good enough to continue easing monetary policy. But the one part of his policy toolkit that has been more debated now is what would he do with the Fed balance sheet? And that's what he's spoken in the past about, in his view, the need for a smaller Fed balance sheet. And I don't think it's a done deal that he would aggressively start reducing the balance sheet there, because that would cause a lot of problems for the plumbing of the U.S. financial system. It would cause a lot of volatility in markets that would be really unnecessary. So I think it's just something we're going to have to watch to see how his views on the balance sheet have evolved, knowing that he's coming in to this role with the expectation that he'll be supportive of keeping financial conditions loose.
All right, that's the U.S. situation. I want to squeeze in the situation in Japan, a big election win. There was market reaction. What does it mean for the broader global bond market?
That was a big event over the weekend, because I think what was really interesting with in Japan, it was a really strong performer last year in the equity market, and conversely a poor performer in the bond and currency markets. And it was all due to this idea that Prime Minister Takaichi coming in would have this very strong pro-fiscal policy stance. And then she gambled with this idea of calling a snap election with the hope of gaining a supermajority in their House of Representatives. And that gamble actually paid off. They did win big. They got above that 2/3 threshold. And so I think what we're seeing on the back of that is actually some pretty good news in that they're being more disciplined about this idea that they want to have some more fiscal stimulus, consumption taxes to support the economy. But unlike the last couple months where there was concerns that a lot of that would be due to more government borrowing, and that was causing a lot of volatility and upward pressure on the 30-year Japanese bond yield, what we saw over this past weekend is that since then they've been signaling that they're mindful of bond markets. They're going to be looking for ways to fund new fiscal stimulus with other revenue measures or expense reduction. And so I think all in all, what this means for a Canadian investor didn't really impact a lot in terms of Canadian or U.S. bond yields. If you were in any type of Japanese asset equities or fixed income, it did well this week. I think the bigger picture for bond markets is that there's clearly a lot of sensitivity around fiscal sustainability. And I think this theme of ensuring that governments are prudent with how they manage their fiscal plans, that's going to be an important theme for a lot of countries, and I'd say including Canada.